Welcome back. When it comes to digital assets, India's tax framework remains one of the strictest in the world. Whether you are a seasoned Bitcoin holder, an NFT collector, or someone who occasionally trades airdrops, the Income Tax Department is watching closely. The rules are absolute. Transactions involving virtual digital assets, VDAs, carry a flat 30% tax on gains, plus applicable surcharges and cess. Crucially, conventional concepts of short-term or long-term capital gains do not apply here. You cannot claim indexation benefits, and you cannot offset your crypto losses against other asset classes, like salaries or stock gains. Let's break down how specific assets, like Bitcoin, NFTs, airdrops, gifts, and overseas wallets, are taxed, and more importantly, how you must report them in your ITR to avoid heavy scrutiny. Let's start with the basics. Bitcoin and other cryptocurrencies. Whenever you sell your crypto for fiat currency, it triggers a taxable event at that flat 30% rate. But what many investors miss is that crypto-to-crypto swaps, such as trading Bitcoin for Ethereum, are also treated as transfers and are taxed at 30%. Peer-to-peer or OTC trades follow the exact same rule. Is there any relief? Yes. Wallet-to-wallet transfers between two accounts held by the exact same person are not taxable because there is no change in ownership. What about NFTs, non-fungible tokens? Generally, NFTs are classified as VDAs and are subject to the same 30% flat tax. However, there is a minor exclusion. NFTs that act strictly as digital receipts or convey ownership of an underlying tangible asset notified by the CBDT may be treated differently. But if you're trading digital art or collectibles, expect standard VDA rules to apply. Next, let's look at freebies, airdrops, staking rewards, and gifts. If you receive tokens via an airdrop or staking, the tax authorities view this as income right at the moment of receipt. You must pay tax based on the fair market value, FMV, of the asset on that day. Interestingly, that FMV value then becomes your cost of acquisition when you eventually sell it, and the future sale will again attract the 30% tax on any subsequent gains. Taxpayers typically rely on the rate quoted by the exchange where the asset landed. What about gifted crypto? Under Indian tax laws, if you receive VDAs as a gift and the total value exceeds 50,000 rupees in a financial year, it is fully taxable in the recipient's hands, unless the gift comes from a specified relative or on accept occasions like a wedding. And a quick warning for holders of dead tokens. If a token's value drops to zero, you cannot claim a capital loss unless there is an actual sale, transfer, or extinguishment of rights recognized by the Act. You cannot arbitrarily write off worthless tokens to lower your tax liability. Now, what about overseas wallets and international exchanges? Many Indian investors use global platforms to hold or trade crypto. Remember that Indian residents are taxed on their global income. Keeping your assets on an overseas exchange changes nothing about your liability to India's tax framework. Failing to disclose overseas assets or income can invite severe repercussions. Today, the compliance net is entirely data-driven. The Income Tax Department matches exchange reporting data, TDS statements under Section 194S, Form 26AS, and your Annual Information Statement, AIS, directly against your filed returns. Inputs are also shared by agencies like the Financial Intelligence Unit. If your AIS shows crypto transactions that you left out of your return, a system-generated notice is almost guaranteed. So how do you report all of this correctly? First, note that crypto investors cannot use simple forms like ITR1 or ITR4. Depending on your overall income mix, you will need to file either ITR2 if you have capital gains or other sources, or ITR3 if you are classified as a crypto trader with business income. Inside your return, you must meticulously fill out Schedule VDA. Unlike other asset classes where you can report aggregate numbers, Schedule VDA demands transaction-wise reporting. You must input acquisition dates, sale dates, cost of acquisition, and sale considerations for every single trade. Common mistakes that trigger tax notices include netting losses across different VDAs, which is disallowed, and TDS mismatches between your records and the AIS. Double-check your statements, report every swap and airdrop accurately, and ensure your foreign holding forms completely transparent and compliant, file before the deadline, and protect yourself from costly penalties. Thank you for listening.